Hey everyone, welcome back to Upside Down Data. Today I want to talk a bit about average risk in the crypto markets. So to start us off, I'm actually just showing the Bitcoin price chart, and this is the way that we usually talk about risk on this channel, right? We'll talk about our risk indicator, our upside downside potential indicator applied to a specific asset such as Bitcoin. And so the way that you can read a chart like this is that, it's the history of Bitcoin's price action, and then it's color coded to the risk model's outputs. So higher values mean higher risk, lower values mean lower risk. And you see it does a good job of quantifying these high risk zones, these tops, these local peaks here, and then also these bear market lows, these really lower risk zones that tend to lead to these big moves to the upside. And oftentimes when we're talking about assets, this is what we care about. We care about Bitcoin specifically, for example. I'm showing you now the raw output of the model across time. So the white line is UDPI level, yellow line is Bitcoin price. And you see that it does a really good job of characterizing risk in the Bitcoin market over this time. But of course, the issue with looking at risk on this kind of perspective is that you're ignoring the rest of the crypto market, right? You're just looking at, here's an asset, Bitcoin. You let the model train on that asset's data. You kind of let it learn about what Bitcoin tends to do, and then it comes up with its estimate of how risky Bitcoin likely is right now. But again, crypto assets don't always move together. They're correlated, so they often will move together to some degree, but sometimes you'll have some assets going crazy, making big parabolic runs, while other assets aren't really doing anything. Sometimes you'll have other assets dumping heavily for whatever reason, while the rest of the market's doing something different. And so sometimes it's useful to look across the entire crypto space to get an idea of how overheated is it, or maybe how oversold is the crypto market more as a whole. So one of the ways that we've gotten at that here on the channel, here at Upside Down Data, is we've created what we call the average UDPI, the average upside downside potential indicator. And really all this is just taking the UDPI readings of all the different assets we follow. It's somewhere around 30 as currently, I think it's around 27 assets that we're currently tracking. And basically we're just averaging together their UDPI levels. So what I'm showing you here is the long-term average UDPI. So the long-term version of the UDPIs care about moves that play out over months, so more macro in its focus. And this is what it looks like over time. Now I'm overlaying the Bitcoin price in the background just so you can kind of get a better visual sense of when things are happening. But again, these levels are not just from Bitcoin. It's an average of all the assets that we're following. And then, of course, the younger assets just kind of being entered into the average as they came into existence and they started having price data to, or UDPI data to contribute to the average. And what's useful about this is you actually notice some things that are a bit different and why looking at averages can sometimes be more useful than just looking at individual assets. So one of the things that we can look at, for example, is over here. So what's interesting over here is that when you look at the long-term average UDPI, it identifies this peak over here as being pretty high risk, right? Above 3, which when we look back in time, that ends up being a point at which tops often occur. The standout here is, Bitcoin's the only one in the average back here, so it's going all the way up to 5. But you'll notice with averages, because you're looking at multiple different assets, it's unlikely that two assets will be up at 5 at the same time, because that tends to be a relatively short-lived thing. Usually that's a blow-off top moment. So generally speaking, when you have an average, you're going to be a little bit less extreme. It's harder to get to 5 or -5 when you have, let's say, 20 different assets being averaged together, because that would mean that all of the assets would have to be at 5, or all of them would have to be at -5 to get down there. So that's just one of the things that will play out with these average indicators, is that generally speaking, you're going to play with a slightly smaller range. You're not necessarily going to be playing all the way up to 5 and -5 on it. But what you can notice is that when we look over here, you'll see that we got up to around 3 at this top, but then also we got pretty darn close back over here also, which now, looking back on it, that's very prescient, right? The model, this average model, was telling us that the market was quite overheated during this time, that we might want to be careful, which was a view that you wouldn't necessarily have gotten from all of the individual assets on their own, or the individual UDPIs, because some assets like ADA, for example, ran up here, then actually came down pretty heavily, and they became, they were cooling off on their UDPI levels, not super deeply, but quite a bit below, 3 when we got up to here. Well, we can see that even throughout this time, even though we do cool off a bit, we're still up in this relatively high risk zone if we just look back historically speaking, which would have again been this early warning that this was a move that was unlikely to be able to just continue off to 100K like everyone was claiming at the time. And then of course we've come back down. But then also when we look at the downside, this is also useful, right? Because it can tell us overall how oversold the market is. And we can see is that there's actually a lot of consistency on the downside of when we tend to find these kind of bottoming points, right? When you get down to around -4, that tends to mark at least local lows to some degree. Now, we actually bounced off of -4 back here in June, and now Bitcoin has gone ahead and set in a new low relative to then. But importantly, again, this is an average risk indicator. A lot of assets haven't done that, first of all. And the other thing that's you can see is that even though we've gone and set in a new low on Bitcoin and some of the other assets, the model still thinks that kind of overall there's actually more downside that's realistic now than there was back in June, which, might actually be true. We don't know. We'll have to wait and see what happens. But, in June, we kind of bottomed there. Then we spent a long time just going sideways, months going sideways before we got this big capitulation coming from the FTX situation. And so, basically the model is saying that it's not quite as sure that we're reaching a likely bottom here kind of in the aggregate for the crypto market. And that's why it's a little bit higher over here. And just again, to kind of compare the Bitcoin UDPI to the average UDPI a little bit more directly. So this is the Bitcoin UDPI over here. This is the average long-term UDPI. You can see how they're different, but they're telling useful information, right? And so one of the places where they are quite different is you can see over here, Bitcoin on its long-term UDPI got up to around 2 here and here, which is risky, right? That's fairly risky. That's certainly above the neutral point. And this is one of those things where if you're exercising a weighted DCA strategy based on UDPI level, it would certainly be telling you that distribution is better there than acquisition, than accumulation. But it wasn't nearly as high. You can see that we actually got quite a bit higher on the average UDPI than we did over here, breaking up closer to 3. Just another kind of warning sign that overall the market was quite overheated, and more overheated than Bitcoin alone would have told you, right? If you're just using Bitcoin as an overall barometer of the crypto market's overextension, it would have been telling you that's a little bit less, risky than what the average was telling us at that time. So it's one of the useful things about having these averages, is that they can actually give us a broader picture of what's going on in the market. And we can also see that if we look at shorter time frames, or the shorter time frame versions of the UDPI. So this is the medium term that cares about moves that play over weeks to months, so shorter in its time horizon than the long term. And here we can actually see the medium term UDPI got up to as high, actually higher than it was at the top here back in spring of 21. Which again is interesting, kind of this early warning that this was quite overextended, this move up here. And indeed, down we have gone. And it's again telling a similar story. It's kind of caught a local bottom in June, but it's telling a similar story to the long term, where it thinks that there's a bit more downside risk currently than there was at these levels. And again, looking out over weeks to months, that makes sense. Here we ended up just mainly going sideways, and then now we're going in, we're setting in, we set in a new low on Bitcoin and some other assets, not all of them, but a number of others, and there could be more room to fall as well. Now, one that's interesting to look at here is the short-term UDPI, which has identified a number of different occasions where things have actually been more risky than you might have thought just looking at individual assets. And one of the places where it really kind of catches my attention is not only to identify these places of relatively high risk over here, you see this spike up that happened back here in May, where we had that kind of fake breakout, that kind of bull trap that happened that then led to this big kind of double capitulation that we got in going into where we are now. And you can see that we jumped all the way up to a bit above 1, which historically speaking, when we look at it, it's just a bit below where we were back here, and it's actually quite, it was actually higher than some of these bear market rallies we got back here in the 2018 bear market. And so that's notable that I was able to catch that. But it's also interesting more recently, got a local bottom back in June. But now what's interesting about this one is it's telling a different story than the longer medium term average UDPIs, because it's actually at a lower level now than it was in June, whereas the medium term, is higher currently than it was back here. And then of course the long term is also, higher currently than it was back in June. And what that tells me is that it's possible that kind of in the short term, kind of days to weeks, so the more immediate term, that the model thinks that it's likely that we're kind of exhausting the short-term downside, and that some sideways consolidation at the minimum is kind of what we might look for here until maybe we go ahead and realize some of that longer-term downside that the medium and long-term average UDPIs are picking up on. So that's something that I'm watching. It's actually notable that the short-term UDPI has caught a bounce here at the same general levels that's acted as kind of support in prior bear markets. Now, it doesn't mean that we can't go off to new lows. You know, the March 2020 crash broke below this. Certainly, it's possible we could get another big kind of oil correlation, go to one event where we just get a big crash across the market that sends things even further down. But currently, it thinks that we're kind of pretty overextended to the downside in the short term. And so when I kind of put all this together, the story that these average UDPIs are telling me is that the market is more risky now than it was in June. So just because we had that FTX collapse doesn't mean that we're suddenly at a lower risk point than we were back then, at least from the model's perspective. In the more long term, you know, there could be more contagion, more things that fall apart that bring us down further. But in the short term, this model is thinking that it's kind of exhausting its downside in the short term, that it would be kind of very plausible and very reasonable to expect some more sideways consolidation at these current price levels, you know, around the 15, 16, 17K ranges, maybe even a possible, you know, short-term rally up to, you know, 18, 19K, maybe even 20 before catching resistance up there maybe and moving back down. I personally tend to believe that sideways is probably about the best we can hope for. I don't think we're going to get any kind of meaningful rally. And if we do go back up and retest 20K, I personally expect that to act as very strong resistance because, you know, a lot of people bought at that level. So a lot of people might take that opportunity to sell at break even if we get back up there. And so I don't think breaking above 20K is going to happen anytime soon unless there's some extreme thing that really pushes up across that. So kind of the overall story then is that short term, I think, you know, it's likely or very reasonable to think that a lot of the downside is played out. That's immediately going to follow from the FTX collapse. But that when you move into the medium and long term, that's where you have to get a little bit more concerned because it's a little bit less, you know, sure thing that that's going to be a local bottom. But again, we are still at these low risk levels. And so generally speaking, you know, unless we really break from history, these are good accumulation zones. And you really see that when you look at these average models. You can see, like, for example, the medium term UDPI stayed really low even through this kind of first big part of this rally going into 2017, right? You know, pretty much going up almost to the prior all-time high for Bitcoin. You know, the average was saying that we're still quite low risk. Now, a bunch of assets like Ethereum, XRP, Litecoin really pumped here, which is what is bringing this up here. Then, of course, we don't get the ultimate spike until kind of Bitcoin peaked, and then we had the big altcoin rally here. But that's the useful thing is that this, you can look at this model and it'll stay quite low even in the beginnings of these bull markets and then really just spike up when things are getting overheated. And it's played out relatively well in the past. And so really with these are also useful to look at when just considering where is the market, you know, is it a good accumulation zone or not? And, you know, sometimes even when the market's moving up, it'll still tell you, yeah, it's not really any more risky now than it was, you know, at lower prices because, you know, it sees maybe some possibility of some continuation of the upside coming. So that's my overall kind of perspective. So I think we can't ignore the possibility of further downside, kind of, especially falling after the FTX collapse, if there's more contagion that kind of bubbles up, more things that happen. But in the short term, the model thinks that, you know, sideways action is very reasonable. So none of this is financial advice. Make of it what you will. But that's just what I'm seeing in these data right now. All right, if you like the content, remember to subscribe to the channel, give the video a like and follow us on Twitter. A lot of updates, better indicators, and more over there.